A silent storm is brewing inside private credit markets, and most investors never see it coming. From hidden leverage to opaque valuations, the danger builds layer by layer, and number one is something almost nobody guesses. Stay tuned. Surprise! Illiquidity is the quiet killer lurking in private credit portfolios, turning seemingly solid assets into hard-to-sell paper. Unlike public bonds, many private loans lack a secondary market, so when investors need cash, they can be stuck holding positions for years. This scarcity of buyers forces sellers into steep discounts, magnifying losses during market stress. Moreover, fund managers often lock capital for long periods, limiting flexibility to rebalance when opportunities arise. The problem intensifies when issuers default and the collateral is difficult to liquidate. As a result, the overall risk-adjusted return can erode quickly, especially in a tightening credit cycle. Up next, we'll explore a covenant-lite trend that further weakens borrower oversight.
Imagine a loan agreement stripped of most protective clauses. Covenant-lite loans make that a reality, and they're spreading like wildfire across private credit. By reducing financial tests and reporting requirements, lenders accelerate deal flow, but they also surrender early warning signals that traditionally flag borrower distress. When a company's cash flow falters, the lack of covenants can delay corrective action, allowing problems to snowball. Historical data suggests that covenant-lite structures have higher default rates during downturns, yet many funds still chase their higher yields. The trade-off is clear: short-term income versus long-term safety. Coming up, we'll reveal how concentration risk can turn a diversified portfolio into a single-point failure.
Hidden in the fine print, concentration risk quietly piles up when private credit funds pile too much capital into a handful of borrowers or sectors. While a focused strategy can boost returns, it also amplifies exposure to sector-specific shocks. Think real estate slowdowns or energy price swings. When a dominant borrower stumbles, the ripple effect can drain a fund's performance and even threaten its solvency. Diversification metrics often look solid on paper, yet hidden ties between portfolio companies can create unintended clustering. Analysts warn that many funds underestimate these interconnections, especially in niche markets where data is scarce. Next, we'll uncover the opacity of valuation practices that leaves investors in the dark.
Few people know that private credit valuations often rely on models with limited market inputs, making them a murky art rather than a precise science. Without transparent pricing, funds may overstate asset quality, especially when using internal mark-to-model approaches. This opacity can hide deteriorating credit quality until a crisis forces a harsh write-down. Moreover, differing valuation standards across managers complicate comparisons for investors seeking consistency. Regulatory guidance remains fragmented, leaving room for optimistic assumptions that inflate returns. When market stress hits, these hidden mispricings can trigger sudden, large adjustments, eroding capital buffers. Stay with us as we examine how leverage magnifies every other risk in the list.
Liquidity becomes a double-edged sword when funds pile on excessive leverage, amplifying both gains and losses. By borrowing to finance more loans, managers chase higher yields, but they also shrink their cushion against defaults. In a rising interest rate environment, debt servicing costs climb, squeezing cash flows and forcing early repayments or restructurings. Historical episodes show that highly leveraged private credit vehicles can unravel quickly when borrowers falter, leaving limited assets to cover obligations. The problem is compounded by the fact that leverage ratios are often disclosed with lag, obscuring real-time risk exposure. Up next, we'll see how regulatory blind spots let these dangers fester.
Regulators often treat private credit as a shadowy cousin of public markets, leaving critical oversight gaps that can snowball into systemic concerns. Because many funds operate outside traditional banking rules, they escape capital adequacy tests and stress scenario requirements. This regulatory vacuum permits aggressive lending practices, such as extending credit to borderline borrowers without sufficient scrutiny. While authorities have begun to tighten rules, enforcement remains uneven across jurisdictions, creating arbitrage opportunities for risk-seeking managers. The lack of uniform reporting standards also hampers investors' ability to compare risk profiles accurately. As a result, hidden vulnerabilities can grow unchecked until a market shock forces a regulatory response. Coming up, we'll discuss how borrower behavior adds another layer of uncertainty.
Borrowers can slip silently into distress, and private credit often discovers the decline too late. Without the rigorous monitoring that public markets enforce, subtle signs, like shrinking margins or delayed payments, may go unnoticed until cash flow turns negative. When a borrower's credit quality erodes, covenant-lite structures provide little recourse, and lenders may have to negotiate painful restructurings or accept losses. Moreover, many private credit deals lack robust collateral, leaving investors with limited recovery options. This hidden degradation can cascade, especially when multiple borrowers belong to the same supply chain or industry. Next, we'll reveal the data challenges that make spotting these problems even harder.
Data, the lifeblood of risk assessment, yet private credit suffers from chronic transparency shortfalls. Many funds receive limited financial statements, often on a quarterly basis, and sometimes only in summary form. This scarcity of real-time data hampers the ability to detect early warning signs of distress. Furthermore, inconsistent reporting standards across jurisdictions create a patchwork of information that analysts must stitch together manually. Without reliable data, stress testing models become guesswork, and portfolio managers may underestimate exposure. Investors relying on third-party ratings also face the risk of outdated or incomplete assessments. Stay tuned as we explore the refinancing squeezes that can trigger a cascade of defaults.
Market conditions can tighten the noose on borrowers needing to roll over debt, and refinancing risk lurks as a silent time bomb in private credit. When loans mature and borrowers cannot secure new financing due to higher rates, reduced lender appetite, or deteriorated credit, defaults can spike abruptly. Private credit often provides longer maturities, but many deals still rely on periodic refinancing to maintain liquidity. A sudden credit crunch can leave borrowers scrambling, forcing distressed sales of assets at fire sale prices. This risk is magnified in sectors where cash flow is already fragile, such as commercial real estate or leveraged buyouts. Up next, the final and most dramatic risk that could upend the entire market.
Finally, the specter of systemic contagion looms over private credit, a risk that could ripple through the broader financial system. As private credit funds grow larger, their interconnections with banks, hedge funds, and corporates intensify, creating pathways for distress to spread. A cluster of defaults in a high-leverage segment could force fund managers to sell assets quickly, depressing prices and triggering margin calls elsewhere. This chain reaction may amplify liquidity strains across markets, especially when other investors lack visibility into the hidden exposures. While historically private credit has been insulated, the rapid expansion and increasing leverage raise concerns among economists that a shock could cascade far beyond its niche. The possibility of such a domino effect underscores why understanding each hidden risk is vital for anyone navigating today's credit landscape.
We've peeled back the layers of private credit and uncovered 10 stealthy risks that could catch even seasoned investors off guard. Understanding these hidden threats not only protects your capital, but also sharpens your strategic edge in an ever-evolving market. If you found this countdown eye-opening, hit the like button and subscribe so you don't miss the next deep dive. New mind-blowing lists arrive every week. Which risk surprised you the most, and how will you factor it into your next decision? Let us know in the comments below. Thanks for watching, and stay vigilant.